Well, hello and a very warm welcome to this webinar, Understanding Climate Risk Impacts on Covered Bonds, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today. And I'm delighted to be joined by Matthias Pleissner from Scope's Covered Bonds team and Arne Plateau, an ESG quantitative analyst who in a moment will take you through a presentation explaining how climate risk amplifies credit risk stresses and can increase the over-collateralisation needed to support covered bond ratings. As they'll explain, impact between asset classes, regions and scenarios are not uniform. They'll also outline the key drivers of the model underpinning their conclusions. After the presentation, we'll be delighted to take your questions, so please type these into the questions tab and we'll get to them later. Now, we did publish a short summary of the key findings of Matthias and Arne's research yesterday, but as a special offer to you, our viewers today, we'll be delighted to offer you exclusive early download of Scope's full research paper on this vital topic, and that will become clear later. So that's it from me. Matthias, Arne, great to see you as ever. Matthias, I think you are going to start, so let me hand over to you.
Thank you, Keith, and welcome everyone, and thanks for joining today's webinar. We're talking about climate risk today, about climate risk concerning covered bonds. And before we start this presentation, it may make sense to quickly sort out where climate risk could indeed affect covered bonds. So here we could certainly start already at the very beginning, so at the issuer rating, and we do have a study out there which we have published early the year, which was also discussing impacts from climate risk to financial institutions, to banks. And all of that basically came down to the underlying assets. And that's exactly what we're talking about today as well. So we're talking about the impact on the collateral of covered bonds and accordingly also the respective sensitivity to the protection levels to covered bonds, namely over-collateralization. I think it's fair to say here, in case you are aware, most of our covered bond programs we do rate actually do not require additional over-collateralization other than the legal limits according to the respective legislation. And this is because the issuer ratings are already very high, and we believe that the remaining notches to AAA typically can be achieved by the benefits of the resolution regime. So the whole question about the secondary cause and the benefits from the secondary cause are, however, still analyzed by us as sensitivity analyses. And that's what we're talking about today as well. So we're looking at these sensitivities and will accordingly also look at how climate risk will affect the secondary cause in regards to potential over-collateralization. With that, I think I added sufficient disclaimers already in advance so that we can kick off the presentation to the most important finding of this sensitivity analysis, which is dealing with the increase of over-collateralization, pretty much depending on the respective collateral. So the core collateral for covered bonds are typically residential mortgages. And here we have calculated that on average, the covered bond secured by residential mortgages would see an increase in over-collateralization by 8%. We have calculated on average 16% for commercial exposures and collateral and up to 12% for public sector exposures. This is indeed material, but to be frank, if we were talking about the nominal increase in percentage points, then there we are talking about 1.1 for residential, still 5.4 for commercial and 1.8 for public sector covered bonds. Having said that, this is significant material. We believe that banks will be able to manage that simply because they are still quite resilient and should be able to cover these additional risk contributions. Before we now dive into some additional sensitivities we have calculated, and before I would like to present you more details on our analyses, I would like to first also give Arne a chance to enlighten us a bit on how the whole climate risk framework actually works, because I'm only the analyst. I'm the one who is applying the vectors, the stress vectors and stress assumption, which are provided by Arne and team. And therefore also I believe in order to get a better understanding on the following slide, Arne, it may make sense that you give us some insights on, well, the ideas behind that framework.
Yes, thank you, Matthias. Next slide, please. So what I want to do is just give you a bit of background on the methods we use to obtain these results. I'm not going to go into details, but I'm very happy to take questions if there were some. But we have a framework to come to this over-collateralization stress, and it consists of 4 steps that we go sequentially through. So we start with an economic risk that comes from external sources, which we then translate into credit risk, and then also look at the specificities of a cover pool to then come to this thing. So to go through these steps a bit more in detail, we have the economic risk as a kind of foundation of our analysis. And there's 2 major economic risks that we look at in the context of covered bonds. There's a macroeconomic component, which is consisting of a GDP loss provided to us by the NGFS, which is a network for greening the financial system. And that's the central bank group, which is providing projections of a lot of economic data under several climate scenarios. And in the context of this study, we look at 3 scenarios in particular. An orderly scenario, where we assume that swift climate change climate action is taken, and as such has quite high transition risk, but also less of a physical risk in the longer run. We have a disorderly scenario, where we assume that climate action is being taken, but only later, and as such has more medium-term transition risk, but then a bit higher physical risk in the long run. And then finally, we also have our hothouse scenario, where we essentially assume that no more climate action is being taken than except what already exists, which means very low transition risk, but higher physical risk in the long run. So that's the first component is this GDP loss, both from transition risk and from physical risk. And then we have also a microeconomic risk component consisting of changes in housing prices. And that is modeled by us internally according to the same set of scenarios as the NGFS. And there we essentially assume that changes in energy and in carbon prices will be reflected at some point in the price of real estate collateral, but also that increases in extreme weather events, as well as the severity of these events, would also find its way into the housing prices if a certain location is exposed to these risks. That's all very good and well, but then the question is how do you then come to credit risk? Which is essentially what we are after. And there we had a lot of historical analyses that we did, where we looked at the sensitivity of default rates and of loss given defaults towards economic shocks, historically speaking. So not per se a climate shock, but rather an overall downturn. And then we kind of, through regression analysis, could find how sensitive each segment is to the economic environment. So assuming that then economic shocks will come from climate change risk, that gives us then a stressed default vector alongside the NGFS projections over the next 30 years. This then, the next step in our framework then consists of connecting that to the specificities of a cover pool. And that means in terms of the segments that make up the collateral, in terms of the weighted average life of the assets as well, in terms of the geography, in terms of energy efficiency, if that is available. And combining these two things then allows us to compute a stress over collateralization based on these stress input vectors. And that is something that we then can compare with the baseline that is not taking these risks into consideration, and gives us then the results that we can present here today. So Matthias already aligned or showed the kind of all top line results, but what is quite interesting is that the results differ quite strongly by scenario. And I hand back to Matthias to give you a bit of insight into how results can differ between the different scenarios.
Thanks, Arne. So let us go to the next slide. And essentially, you see again what I have presented already at the first slide. So we see 8% increase residential, 16 commercial, public sector 12%. But we see another layer, and that's actually then the result per stress scenario according to these NGFS scenarios that have just been mentioned by Arne. When I was doing my sensitivities and looked first at some residential mortgage portfolios, I have to admit I was completely puzzled. Puzzled because I had trouble to fully understand the results, and also afterwards puzzled to find a good way to present the results. So I asked Arne what the key drivers here are, because what we are seeing is essentially 8% under an orderly scenario for residentials, 4% under an hothouse. So the brave way, the orderly scenario where society invests into a more sustainable future, this comes at huge costs. And if you compare that to the hothouse with a 4%, actually double protection based on the underlying collateral, which in that case is residential. And I said, I was puzzled. I was asking Arne, and he was saying, look, it somewhat makes sense considering the framework we do apply, because what we are doing is we are stressing affordability. What we are doing is we assume higher energy costs. We assume higher carbon taxation. And that essentially will, of course, put additional stress on affordability. With a stretched affordability, we might also see that certain households might not be able to fully service their debt, and ultimately might lead to a default. But it's not only the default rate we look at. Also, under an orderly scenario where we obviously do have transition costs, we face likewise increased haircuts on the properties. So potentially a stress on recovery rates, because these additional costs need to be sized into the property values as well. And this is ultimately causing not only a higher default probability, but potentially also a lower recovery rate. And this in particular in the transition scenario, in an orderly scenario. If you now look at the commercial segment, the picture looks quite different. We don't have that much of a sensitivity in regards to the disorderly and the hothouse scenario. But what is certainly striking here is the fact that we have double the increase in protection compared to the residential, or even more than double. I was puzzled again and asked Arne what the reason for this strong sensitivity is. And he was saying, actually, the stresses we do apply are not that much different from residential. So they are certainly not higher compared to the residential. But he was also saying that it might be reasonable to look at the basis, because the stresses we do apply on the default probability, for instance, are a vector of multipliers. So we multiply our default probability with a vector of stress multipliers depending on the respective NGFS scenario. And given that the basis, so the commercial borrowers, our assumptions follow higher default probabilities opposed to a portfolio of granular residential mortgages, we also end up in a higher sensitivity in regards to these scenarios. When it comes to the public sector collateral, again, a completely different picture. An interesting picture, though, because there is not a single impact under an orderly or in disorderly scenario. So this is actually equal to our base scenario. Me being puzzled again, asking Arne, and he was saying, look, I mean, it's pretty clear here, because for a government, for a government, under an orderly and disorderly scenario, they essentially will receive taxes. And taxes, of course, are positive to the fiscal situation of a sovereign. And accordingly, this could even be credit positive. While at the same time, under a hothouse, there wouldn't be any kind of taxation in regards to carbons. What we would face potentially would rather be economic shocks due to climate warming, to the hothouse scenario, that could certainly dampen the economic situation and finally increase the default probability of the public sector. So this is one criteria which is certainly essential to understand when analyzing not only covered bonds, but generally underlying collaterals. But in particular, when looking into covered bonds, what certainly matters is the regional distribution. And also looking here into our framework, we observe that obviously here the regional distribution matters quite significantly. From now on, I will focus more on residential mortgages, because this is the core segment for covered bonds. What we see on the left-hand side describes on an artificial example portfolio the default probability multipliers we do apply. On the right-hand side, you see value haircuts, so basically the recovery rate side. But let's first focus on the left-hand side, the default probabilities. So here we see that there is obviously a huge difference between countries in the north and countries in the south of Europe. And in particular, we see here a huge exposure to the south, Spain, with an increase in default probabilities of 44%, opposed to only 3% in Finland, for instance. When I asked Arne again, what are the key reasons for this differentiation, he was saying, look, I mean, it's again a matter of affordability. Because what we face in the south opposed to the north is certainly that affordability and finally the net disposable income might be slightly lower. But that's not all. Also, the costs in the north would be lower accordingly. In the Nordics, we typically have the highest share of the usage in regards to renewable energies. And this is, of course, positive to potential cost increases of energy from carbon taxation in the future. So in the north, we not only face a potentially higher net disposable income, but we also face a situation where we do or might have to pay lower costs on energy, compared at least to other countries within Europe. Looking at the right-hand side, the value haircuts, which we have calculated, we see a different picture. We actually see that highest value haircuts for our portfolios here would be attributed to the central of Europe. In particular here for Germany, we see 12% value haircuts on average on such an artificial portfolio and 1% only for Finland. But also Spain here is standing out with a very low haircut. If you would like to understand where this haircut is actually coming from, I would like to quickly switch my screens and share with you a dashboard which is made available to analysts, which allows us to dive a bit deeper into the rationale of different stresses we do apply. I hope you can see that now, and what at least I do see and should be shared with you is the map of Germany, while we see this amongst a NUTS 3 level. We essentially see here house price declines, which we would apply under an orderly scenario on average. And we see also that the map obviously seems to be kind of split, because in particular here in the eastern part of Germany, we see some red areas. And if I hover over those, this is Salzlandkreis, we have calculated a house price decline at its peak level, after year 28 of 73%, which is obviously massive. If we look somewhere else, Würzburg, 24%, which certainly is significantly lower. So now, why do we face such high declines in areas in Sachsen, Sachsen-Anhalt, and Thüringen? This is driven certainly by the fact that we're talking here about very rural areas. We're talking about an older stock of properties where also the average EPC grade or score is significantly lower. But we are also talking about properties which do have already a relative low price. And due to that, assuming that we might have to transition, including very high energy costs plus carbon taxation, take into consideration rather poor EPC scores, the collateral would need to be reassessed, including, of course, these transition costs. And if this would be the case, we would indeed potentially see these additional haircuts. But we see more here on this graph. We see also here on the left-hand side some kind of red lines, which is the River Rhine Valley. We see it essentially better if we switch to a hothouse scenario, where we see two things, by the way. First of all, on the right-hand side, those countries where earlier we have seen huge transition costs now disappeared, because under the hothouse scenario, there is no transition. But climate warming could lead here, in particular in the Rhine area, but also Weser-Elbe area in the north, to some physical risk, which might come with additional house price declines. Let me go back to the presentation and move to the next slide. So here we address both physical and transition risk. Essentially, we see the same what we have seen before, because this simply reflects house price decline split into physical and transition risk. And we already had a look into Germany and have seen that obviously transition risk was dominating. At the same time, some of those selected countries also show to have a completely different picture, like the Netherlands or like Sweden. In the Netherlands, we do have a 50-50 split. In Sweden, predominantly physical risks. And let me very quickly go back to the dashboard, because it might help to better understand what's happening also for the Netherlands and for Sweden. So moving to the Netherlands, what we actually see is that we obviously do have a lot of exposure, transition exposure within the coastal area. But likewise, we do have exposure mostly also to the coastal areas coming under hothouse more from the physical risk. Now, what are the drivers? I mean, we know that Netherlands is certainly not necessarily built on the highest altitude, which exposes the land significantly to risks like land subsidence and sea level rise. And this, in that specific case, is very much driving both physical and transition risk. Completely different picture, though, for Sweden, which might look a bit odd. I mean, first of all, Sweden looks quite green. And this is driven by the fact, I said it earlier, that the Nordics benefit from a strong usage of renewable energies. And by the way, Sweden obviously here is even the leader in regards to the own usage of renewables. But we do have this one region outstanding. It's called Jämtlands län, most likely pronounced wrongly, but this is certainly an outstanding region where we indeed face risk of flooding. This flooding also comes here from kind of a hilly region where we do have a couple of valleys and some towns and smaller cities being located to these regions. And what does it mean for covered bonds? Of course, if we do have a covered bond analysis, we need to consider also the region distribution. If we were only to look at the Stockholm region, we face something like 10% additional haircuts. But if we were looking at some local covered pools, then certainly climate risk might matter quite significantly. Let's go back to the presentation and move to another contributor of, let's say, risk, or another measure which is important to take into consideration when analyzing covered bonds. The plot you see on the left-hand side essentially again is kind of just the split of house price declines into transition and physical house price declines, but in a plot. But I don't want to discuss now this plot. I just want to have this plot on the left-hand side compared to that on the right-hand side. So we obviously see these dots reflecting risk. And on the left-hand side, these dots are all moving towards the bottom left side, indicating lower risk. All I did on the right-hand side is basically for those portfolios increasing seasoning, which essentially led to a lower weighted average life. And that obviously does have a huge impact on credit risk and ultimately also the protection levels for covered bonds. Here, which also is my last slide, I would like to dive a bit deeper into this effect, which shows that, first of all, this effect of weighted average life is not only allocated to house price declines, recovery side, but also to the default probability, which we see on the left-hand side. These vectors here in green, red, and yellow is what I do receive from Arne. And if we now focus first on the left-hand side, the PDs, and on the green vector, what we see is that obviously this vector appears to be front-loaded, at least more front-loaded, opposed to the hothouse or disorderly vector. And if we take this into consideration, in combination with what you see in the background, this gray shade, which should reflect an artificial amortization profile, it matters significantly where we are in time. So the front-loaded vector will be weighted with a high outstanding balance. But if we would now look at where the orderly crosses the hothouse scenario in year 20, we also see that the remaining balance is quite low and even reducing over the next 10 years, which also means that whatever happens afterwards does have a very low relevance to our assessment. And considering that in particular, the transition risks are what is more or less front-loaded in our analysis, and the physical risks, which come later, are less reflected in our analysis due to the lower weighting driven by the weighted average life of a portfolio. We also have to admit that finally, when we do analyze covered bonds, when we consider the remaining weighted average life of a portfolio, we might more have reflected transition risks opposed to physical risks in our analysis. You could call this a limitation. And indeed, I mean, we might also highlight further limitations to our analysis as, for instance, and in particular, if we look at covered bonds, where we're talking about replenished and managed portfolios, we should also consider that certainly households over time might invest. They might invest into a new heat pump, they might invest into insulation. And this, of course, could positively affect not only an EPC grade, but also the energy consumption ultimately. This is something we don't yet consider. What we consider is more like the pure cost element, which we expect to increase over time, depending on the scenarios we are calculating here. Another limitation to our analysis, as always, certainly are information. What we require in order to do a proper analysis is, of course, quite regional data. As you have seen, NUTS2 level data might help in order to perform a proper analysis, and this is not only available, in particular not if we look at public information like the HTT. EPC data would also be of huge relevance and importance because we might face a positive selected covered bond, while if we don't have this data, we would have simply to assume that we would face a country's average in regards to the EPC distribution. With that, I went through most of the elements which I believe should be highlighted in regards to climate risk and its impact to covered bonds, and hand over to you, Keith, for some final words or potential questions.
Yes, indeed. Thank you very much, Matthias and Anna, for your comments. Some fascinating conclusions there, I must say, and I guess potentially counterintuitive as well. But look, there's some questions I have here, and they're a bit of a sort of mix. So if you don't mind, we'll just jump in around and jump up around the questions. The first one, perhaps Matthias, I can put this to you, is that you know, I'm sitting here in London. I'm thinking, why didn't you show impact for UK covered bonds? Is there any particular reason for that?
Well, there's a simple and quick answer. So I was showing a selected portfolio of country exposure. UK is not part of that because yet a coverage. So this was not part of my selection.
Okay, that's pretty clear. Thank you very much. And this, I guess, let me turn to you, and perhaps Matthias, you can follow up with your comments as well. And the question is, don't you think that prices on properties with low efficiency already reflect expected price increases? And so perhaps your analysis maybe overestimates the impact of climate risk on property values.
That's a good question, and that's a question that we have been debating a lot internally as well. I would say there's a few elements I would highlight in that regards. I think first of all, we do only look at increases of prices and of energy and carbon taxation prices. So we do not consider the current level, given that this is already, in our view, reflected or should be reflected already in the price. So to that extent, I think we have a forward-looking basis. However, it's something that Matthias already alluded to, is that what we currently do not consider is renovation and is increases in energy efficiency, which I think is quite fair to assume that that people, in case that a very high carbon price were to materialize, you would expect people to indeed start renovating or changing their behavior. This is not modeled yet, as of yet, given that it also comes at a certain cost, and that especially for borrowers, that might be prohibitive, and we there prefer a bit of a more conservative assumption.
Well, I could only add that I believe, I mean, there's so much uncertainty in the market, uncertainty in regards to politicians and political decisions, that I don't think that any of the scenarios here and highlighted today would be fully reflected as of today in the respective evaluations of property prices. It's kind of a moving target and pretty much depends on the respective debates within a society. But for now, no, I think that stress levels as presented as of today are not yet reflected.
Yeah. Okay, let's stay on this issue of energy efficiency. Anna, how do you assess energy efficiency in of a given portfolio?
So that depends on the data that is really available to us. So we do, for each of the countries where we do model the value declines for, we do have proxies based on the EPC and on average electricity use or energy use per EPC grade. So we do have that available, but the question is really, is that data also available for the cover pool? And that is where it's currently a bit of a problem still.
Yeah. Okay, Matthias, I've got a question about covered bonds ratings, but we'll just I'll just hold that for a second and stay with you, Arne, if I could. Which is, no, you talked about the Nordics, and the question really is, why lower transition risk in the Nordics? I mean, because in a real world context, obviously energy consumption should be higher because it's colder.
Yeah, that's correct, and it's maybe a bit counterintuitive as well. But what we see is that the energy or the change in current price is also affecting it only through the carbon content of your energy, and the Nordics are quite carbon efficient, like Sweden in particular, but also Norway have a lot of hydropower. They have a lot of communal heating systems, etc. And these things obviously don't have the same impact as, say, as a country in Germany or Belgium, where you would have a lot of gasoline heating or a lot of natural gas, and that is gonna, of course, be much more costly than if you're on a communal heating system.
Yeah. Okay. And so, Matthias, this is about ultimately about covered bonds and climate impacts. But I guess, the question to all of this maybe is, so, what am I supposed to do about it? And so when the rubber hits the road, are there any covered bonds that, that you rate where stressed OC levels merit rating action?
Well, first of all, what has been presented today is a sensitivity. That's not part of our rating methodology yet. However, of course, we do test sensitivities towards our over-collateralization levels. I said it, however, also early here in this presentation, that most of the ratings we currently do cover benefit from very high issuer ratings. And with those, we don't have necessarily to include into our rating assessment the secondary cause, in a sense that this might drive over-collateralization level. So the quick answer to your question is no. Banks are very much resilient. Ratings are typically very high. And even if the secondary cause would be required, according to our analysis, to reach highest ratings, the over-collateralization levels maintained would also be sufficient in order to cover these potential additional sensitivities.
Yeah. Okay. Cool. Look, I've got no more questions lined up, and so unless either of you has anything more to add, I suggest we close the session. But I do add, or hang on a second, a question. We do have a question. Okay, let me just read this out, and perhaps you can jump in. The question is as follows: is it possible to put a number on the house price drops needed to happen in severe climate scenarios, brackets, possible rating downgrades, for covered bond OC to rise and or spreads to widen? It's a perhaps putting on the spot a little bit. Perhaps you can answer generally.
No, because the right answer, as always, is it depends. In regards to our coverage, I don't think that we face any cover bond program being exposed to a pool that is so much concentrated to a region which would very strongly be affected by either transition or physical risk. So we typically do face well and granular portfolios where a single house price decline or default probability hit wouldn't also hit then the respective rating. So it pretty much really depends. But on our coverage, I would say, I mean, I don't see yet from the stresses we have applied accordingly that there would be any strong impact. But I'm not quite sure whether I really fully understood the question. So it's more like whether, okay, I mean, maybe the question more relates really to a direct impact from house price drops into increase of over-collateralization. That would be kind of like a formula also. And no, we don't have that. We don't have that. Because it also is pretty much depending, and this needs to be set finally on very much other criteria, because credit risk certainly is driving over collateralization and ratings of covered bonds, but it's certainly just one of many parameters. As for covered bonds, we are also talking about mismatches between assets and liabilities, interest rate, foreign currency mismatches, maturity mismatches, which are likewise driving in end, which do have interferences with credit risk, of course. So there is certainly no linear function.
Yeah, no, that makes absolute sense. Cool. Let's say, look, I think we should close the session there. Now, if any of you do have any further questions for Matthias or Arne, please feel free to reach out to them or to myself, and we can always circle back to you one-on-one offline. I did say at the beginning that we would make the research that we're about to publish downloadable today. And so hopefully now, by magic, they will appear on screen a download now button. So feel free to download the report. And of course, anything that comes up as you read the report, it goes into quite some detail, not just about the covered bond aspect, but also about the model that Arne and Matthias talked about. So we'll absolutely welcome your feedback, any questions you might have on that. Now, clearly, you know, this topic is not going to go away. And so we will continue to monitor developments and any further issues that arise that we think warrant another session on this. We will, of course, set one up. So thank you so much for dialing in and watching till the bitter end. Thank you, Matthias. Thank you, Arne, for your comments. And we'll leave it there and wish you a very successful rest of the afternoon. So it's goodbye from us.
Thank you.
Thank you. Good night.